Fundamental Analysis Part 5, Analysis of Balance Sheet. What is a balance sheet? Balance sheet is a statement which provides all the details relating to company's assets, liabilities and capital. In the balance sheet we will have two categories, one for the company's assets and another for the company's liabilities. Liabilities will include shareholders' equity as well as the company's liabilities. In this tutorial we will be analyzing a balance sheet of the company Hindustan Zinc Limited. The balance sheet is extracted from moneycontrol.com. Let's start with analysis of liabilities in the balance sheet. In this balance sheet of Hindustan Zinc, the first section under liabilities is named total share capital and equity share capital. This represents the initial capital introduced by the company, in case, if there is any additional capital which is introduced by the company, then there will be a change in the total share capital. The second section under liabilities is the reserves. Reserves is any part of shareholders' equity, except for basic share capital. The net worth of the company is equal to sum of reserves plus the total share capital. After the company reports yearly profit, the net profit won't get added to the capital as in case of sole proprietorship, but they are kept under a separate account of reserves. And the shareholders have all the right to claim their part of the reserves during the company's liquidation. In a balance sheet one needs to watch out for increasing reserves. This indicates that the company has been consistent in reporting profits. And then the third section under liabilities is debts. Debts are nothing but loans. Debts can be classified into two categories. The first is secured loans. If the company has taken secured loans, it creates a charge on the assets of the company, whereas unsecured loans do not create any charge on the assets of the company. Lastly, under liabilities we have total liability. The total liability of the company is obtained by adding up net worth of the company and the total debts of the company. Therefore, total liability equals total share capital plus reserves plus company's debts. Next, let's analyze the assets in the balance sheet. Under assets the first section we have is gross block. The gross blocks are the value of all the depreciable assets before depreciation. Next we have is less, accumulated depreciation. This value represents the total depreciation of the depreciable assets. And next is net blocks, which is the present value of the asset after subtracting depreciation. The second section we have under assets is the investments made by the company. The investments can be in any securities or assets. One needs to watch for increase in investments by the company, because investments is one of the ways to improve the income in the longer term. Next, the third section under assets are net current assets. Under current assets we have various assets such as debtors, inventory, cash balance, bank balance, loans lent by the company, etc. From these current assets, when one subtracts the current liabilities, we obtain net current assets. And lastly under assets we have total assets. This includes sum of all net blocks, investment by the company, capital work in progress and then net current assets. Therefore total assets equals net blocks plus investment by the company plus capital work in progress plus net current assets. Lastly in the balance sheet we have what is known as book value. This is the most important item. This indicates that at the point of time if the company gets liquidated or turned into cash, what is the worth of each share of the company. By obtaining the average book value growth, one can estimate what will each share of the company is worth of in coming years. Let's now see what to look in our balance sheet. Under liabilities, one needs to look first at the reserves. Under reserves and net worth, one needs to see whether the reserves grow every year. Increase in reserves is one of the factors which indicate good growth in profits. Next under assets, one needs to watch for increase in investments. Investments increase the potential of the company to report good profits in coming years. Lastly, under capital one needs to look at increasing book value. The average book value growth can be found out using any calculator online. As we can see here, over the period of 5 years, the book value have grown from 53 to 102. When we calculate the average yearly growth we get the growth of 13.990% per annum. This indicates that the value of the company is growing by 13.9% every year. or the value of each share is growing by 13.9% every year. Here we come to the end of this tutorial on analysis of balance sheet. Please like and subscribe.